Oil is often called the lifeblood of the global economy. Even in a time when renewable energy is being adopted rapidly, oil still remains the single most important commodity in the world. In this video, we'll talk in detail about oil trading for beginners, understanding the fundamentals and the major players that influence its price, as well as the details of trading oil online and how to read its chart and determine which way the oil price could be heading. Let's quickly go over the most basic principle of the oil market, the relationship between supply and demand. Supply for oil mainly comes from three sources: the United States, Russia, and last but certainly not least, OPEC, a global group of countries usually led by Saudi Arabia. OPEC stands for the Organization of Petroleum Exporting Countries, and alongside the vast Russian and American oil reserves, it supplies the global economy with the energy that powers industries, transport, and homes. Its daily output is a staggering 88 million barrels, proof that this is a key industry for all countries across the globe and how they function. On the demand side, we have the largest economies in the world, the United States, Europe, and China, followed by a mix of large and mid-sized economies that don't have reserves of their own, countries such as Japan and India. To put it very simply, the balance between these supply and demand sides determines the price of oil. But here is where it gets a bit more complicated. There are several different types of oil, and of course they have several different prices. But the two most popular types of oil are called WTI and Brent crude. WTI stands for West Texas Intermediate and shows the price for oil coming from US fields, which are mainly located in the Gulf of Mexico. Brent oil refers to the oil produced from the fields in the North Sea. We have another detailed video about their differences and similarities. You can click the link on this video in the top right to watch it. So we know there are two types of oil that are traded. We have Brent crude and West Texas. Let's take a look at them on the platform. So if I type in oil into the search box, you can see right at the top there we have crude oil, which is the West Texas. That's the cash price. Then we have Brent oil down here. So you can see if we go over, crude oil is trading the West Texas around $42.58. And Brent oil is about, $2.30 more expensive at the moment. So there is a difference in price because there's a difference in quality. But if we take a look at the charts, the moves we see are clearly pretty much the same, even though there is a price difference between the two grades of oil. So first of all, here's our crude oil, which is our West Texas oil, the cash market. And you can see over the last couple of weeks, it's gone from a low of about 34, currently trading at 42.60. So it's risen around $8.5. Let's take a look at Brent crude. So the same move, Brent crude has gone from lows below 37 to trade at the moment just shy of $45. So we've seen more than an $8 move in Brent crude as well. So I think it does illustrate that whilst these are priced differently in the markets, West Texas versus Brent crude, the moves we see, not surprisingly, are broadly similar. So let's talk about the difference between the cash price and the futures price. Let's just go and have a look at the commodities section here on our trading platform. So at the top, we have the cash price of crude oil. That's West Texas on our platform. So in effect, it's a contract that just trades continually, and it's the spot or the cash price for the market today, currently trading around $42.60. If I just scroll down here, here we can see US crude oil futures for December. That's trading at a different price, trading currently about $42.38, as you can see. So there is a difference between the cash price and the futures price. In futures markets, the contract has a definite expiry date. So there's a time when that contract stops trading. So traders will close their trades out usually ahead of that expiry. But with the cash market, which tends to be probably the most popular way for many of our clients to trade it, it's a contract that just runs on. If we take a look at Brent crude, we can see the same thing again. So at the moment, Brent oil, the cash market, is trading just below $45 at $44.94. And if we look down here, so we have Feb 2021 futures trading at $44.96, and then January 21 trading at $44.79. So again, you can see a slight difference at the moment between the cash and the futures price, and this can the difference can be bigger than this, but there are two alternatives when trading, or to trade the cash or the futures. There's no right or wrong way of doing this, but lots of people, I think, when short-term trading using contracts for difference, do look at the cash price, but you have the futures price in there as well. There is a weekly announcement that can have an impact on the price of oil, and that's the crude oil inventories. It's basically a figure showing the stockpile of crude oil, the change from week to week. So it can have an impact if the market thinks there could be oversupply or a lack of supply, depending on how the stockpile is looking, based on what the inventories are telling us. So normally announced on a Wednesday at 3:30 UK time, or 3:30 in the afternoon UK time, or 10:30 in the morning New York time. You can go onto the website Capital.com and go to the economic calendar to see major upcoming events. We did have an inventories announcement the day before filming this. Let's take a look at the effect it had on the market. So 3:30 UK time was the announcement. So it's this candlestick here. These are 5-minute candles. So this one here is the period 3:30 to 3:35. And we saw a fair bit of volatility. The price traded down near 41.80 and pushed up towards 42.30. So we had an almost 50-cent range in the price of oil over the 5 minutes immediately following the inventories announcement. So you can see it does add volatility to markets. In this example, it didn't really change the overall trend, but it's something to watch for on a weekly basis when it comes to oil. So let's talk about actually trading oil. So I've got here crude oil, which is our West Texas crude, US crude, the cash market. The price is currently trading around $42.52 a barrel. This is a very short-term chart of what's been going on today. So let's talk about why you might want to trade this with contracts for difference. There are a few benefits. You don't actually own the oil. You're trading a derivative based on the oil price. It will move in step with what's going on in the oil market. You have leverage, so you're using margin. So you'll see that in a second when we set the trade up. So you don't need to tie up all of your capital in the value of the trade. Plus, you can trade the market in both directions. If you thought the price was going to go up, you'd buy. If you thought at $42.50 oil was too expensive, you'd sell. Let's do a buy trade first of all. I'll show you how it works. So let's say I'm going to trade oil and I want to buy. I think the price is going to rise from here. The price is currently $42.58. Clearly, it will keep updating as the price is moving around. So in essence, I'm buying 1 barrel of oil. I've put my size in there. I'm buying 1 barrel of oil, but I'm not tying up $42.58 from my account because I'm trading on margin. I'm using leverage. I'm only tying up my initial margin here. So you can see £3.20 is what I would tie up on my account. So if I wanted to trade, for example, 100 barrels of oil, so I now have at $42.50 a barrel, a $4,250 position in the price of oil. I only tie up £320 of margin. So this small initial deposit controls a much bigger position. Of course, using margin and leverage cuts both ways. It can magnify your profits, but it can also magnify your losses as well. So it's important to have risk controls in, such as stop losses. But that's an example of how leverage works when we're trading this. Let's say we thought actually at 42.55, I thought the price of oil was going to drop. Then of course I can sell. I can click on sell. So I don't have a position in oil at the moment. I'm opening up a position to try and profit from the price dropping. So let's knock that right back down to 1 barrel of oil. The price is currently trading at 42.50, 42.45. Again, I'm trading on margin. If I click on sell, you can see my positions opened. So I've sold 1 crude oil at 42.49. So I've positioned myself to profit from a slide in the price of oil. Let's take a look in the portfolio. So here's the trade I just did. So opening it up, -1, so I'm short oil from $42.49. The price is currently $42.54-ish. My margin requirement is here, £3.20. And I'm currently losing about 4 or 3 pence on this trade. And of course, if I change my mind, instant execution, I can close the position and it's gone. So I've closed it out. I've made a small loss of 3 pence in this example, but it shows you with contracts for difference, you have leverage and you can trade markets in both directions. That's it for our introduction to oil and oil trading. I hope you find it interesting. Don't forget, there are plenty of other educational videos on our channel, so take a look at those. If you click on subscribe, you'll never miss out on the content we produce, typically 4 videos during the week. But from me, David Jones and Capital.com, we'll leave things there. Good luck with your trading. For more trading videos just like this, please subscribe to our channel.